Today I'm taking you through a comprehensive deep dive into the latest on Bitcoin and Ethereum, two pillars of the crypto world whose dynamics have been evolving in fascinating ways. In this narrative, I will describe a detailed breakdown of on-chain data, market sentiment, volatility, and the underlying technical and economic drivers. The tone remains relaxed yet precise as we explore smart money accumulation, long-term structural trends, and the advanced mechanics that make these assets so compelling. We will delve into the technical signals and historical patterns behind Bitcoin's shrinking supply and Ethereum's evolving utility, all while painting a picture that balances numbers, technical facts, and nuanced market insights. Let's start with Bitcoin. Over recent weeks, Bitcoin's on-chain indicators have drawn the attention of sophisticated investors, and the data reveals a clear pattern that goes beyond mere price volatility. Specifically, a noteworthy sign is the persistent smart money accumulation during periods of short-term price weakness. Even when sharp red candles and sudden dips hit the charts, the on-chain flow consistently indicates that Bitcoin is leaving exchanges and moving into long-term storage wallets. This phenomenon is significant because when coins are withdrawn from exchanges, they become less liquid and therefore harder to sell rapidly. Essentially, it signals that investors who think in months or years rather than mere days are quietly amassing positions while the market fixates on short-term fluctuations. Advanced on-chain metrics show that Bitcoin's exchange supply is shrinking consistently, a factor with significant historical implications. Periods of declining supply, when paired with deliberate accumulation by long-term holders, have repeatedly preceded major upward price expansions. Technical models based on historical data suggest that while the exact timing of these expansions remains difficult to pinpoint, the structural pressure building underneath Bitcoin's price action is both measurable and significant. For example, when we look at the flow data, we see a consistent migration of coins from transient exchange wallets to cold storage, which statistically correlates with subsequent price gains after periods of market consolidation. Shifting to the price action itself, Bitcoin has recently experienced one of its sharpest weekly pullbacks in several months. This move saw prices dip below critical psychological levels, triggering an unwinding of positions held by traders who entered the market at later stages. Yet, despite that aggressive pullback, the underlying accumulation by long-term holders has remained undisturbed. This type of price correction is important for the market's health. It allows for an orderly process where over-leveraged positions get liquidated, funding rates are recalibrated, and liquidity is freed up for future moves. In technical terms, these pullbacks help to reset the market structure and lay the groundwork for larger, more sustained price movements. In a market where volatility reigns, such large corrections serve a dual purpose. They clear out weak positions and rebalance trader psychology by separating long-term structural investors from those driven purely by emotion. In statistical analyses, spikes in volatility tend to wipe out the less resilient market participants, while reinforcing the positions of those who employ probability-based strategies rather than succumbing to panic. A key takeaway from Bitcoin's current state is that the correction is more emotional than fundamental. The long-term bullish structure remains intact despite the temporary price dislocations. Indicators such as institutional flow data, increasing miner activity, and supportive sentiment measured by on-chain metrics all point to an underlying bullish infrastructure. One needs to pay close attention to sentiment cues at this juncture. Current market sentiment points to caution among retail traders, evident from decreased retail participation and elevated fear indices. For expert investors, such cautious sentiment actually provides an entry point. Evidence accumulated over years of research suggests that periods of heightened fear have historically been early signals of subsequent market rebounds. When retail participation is low and negative headlines dominate, smart money typically finds these conditions ripe for accumulation. So, while the narrative may seem grim on the surface, the macro indicators reveal that the fundamentals remain robust, and the potential for turning short-term volatility into long-term upside remains promising. To summarize Bitcoin's current fundamentals, exchange supply is shrinking, indicating lower immediate liquidity. Long-term holders are steadfast, with distribution remaining minimal. Institutional interest, while relatively subdued in the noise of day-to-day volatility, continues to play a silent but powerful role. Even though volatility is high, the steady structural flow suggests that short-term moves are more a matter of liquidity management than a fundamental shift in sentiment. These observations paint a picture of a market that, despite its volatile nature, is built on sound technical and economic foundations. For long-term investors, this environment is well-suited to gradual accumulation rather than rapid trading. For short-term traders, however, the onus is on strict risk management practices, ensuring that positions are sized properly and stops are set to defend against the inherent unpredictability of the market. Now, turning our attention to Ethereum, we find a narrative that is both distinct and equally compelling. Ethereum's transformation from a merely programmable blockchain to an asset that is yield-generating, utility-driven, and scarcity-prone marks one of the most significant evolution stories in the crypto space. The process of staking, for instance, has become a fundamental element of Ethereum's value proposition. With more ETH being locked up in staking contracts, a significant portion of the circulating supply is removed from the trading market. Combined with Ethereum's fee burn mechanism, where increased network activity leads to a reduction in the total supply, this creates an environment where available ETH shrinks over time, reinforcing scarcity and supporting upward price pressure. In detailed on-chain analysis, the relationship between staking and fee burn emerges as a critical driver of Ethereum's long-term value proposition. The more Ethereum is utilized across decentralized applications and protocols, the higher the number of transactions, and consequently the more frequent the fee burns. This dynamic results in a net contraction of the circulating supply, particularly during periods of high network activity. As a result, even if short-term price swings remain erratic, the long-term supply curve exhibits a definite downward trend, a feature that adds a layer of security and scarcity similar to that of Bitcoin, but with an additional utility factor embedded into its design. Layer 2 networks are another cornerstone of Ethereum's expanding narrative. Networks such as Arbitrum, Optimism, Base, and zk-Sync have been rapidly growing and now process massive transaction volumes while still relying on Ethereum for final settlement and security. This growth is more than a scaling solution. It is a sign of Ethereum's increasing role as the base layer for a multitude of decentralized ecosystems. Every transaction that moves to a Layer 2 network reinforces Ethereum's underlying value as the robust settlement layer supporting these operations. Essentially, Ethereum's scalability solutions are not reducing its importance. On the contrary, they are augmenting its overall utility and economic weight. The domino effect of increased network usage on Ethereum is clear. More usage leads to higher fees. Higher fees then result in increased burning of ETH, and as more ETH is burned, the circulating supply tightens, increasing scarcity. This sequence of events underscores why Ethereum has emerged as a hybrid asset, a unique convergence of technology, yield generation through staking, and inherent commodity-like scarcity. From a technical standpoint, Ethereum's on-chain data reveals that even when the price is choppy, core metrics such as staking growth, gas burn, and Layer 2 transaction volumes continue their upward trajectory. Such data-driven insights suggest that Ethereum's economic narrative is expanding steadily, little affected by short-term price volatility. When we juxtapose Bitcoin and Ethereum, the picture that emerges is both fascinating and instructive. Bitcoin is steadily evolving into a macro asset, a digital store of value akin to gold for the institutional investor. Its dynamics are characterized by a tightening supply, deep-rooted institutional commitment, and a guarded approach to liquidity during volatile periods. Ethereum, however, is carving out its own niche. It is positioning itself as digital infrastructure, the foundational layer for decentralized applications, scalable solutions, financial systems, and programmable value transfers. This distinction creates an environment where both assets exist in complementary roles, rather than direct competition. From a strategic perspective, the interplay between Bitcoin and Ethereum is crucial for those involved in trading and long-term investment. Historically, Bitcoin often leads the market in bullish cycles by capturing significant inflows and setting the tone for broader crypto market sentiment. Once Bitcoin's trends stabilize, Ethereum tends to deliver stronger percentage gains, driven by its dual role as a utility and scarce asset. Conversely, during corrections, Ethereum can sometimes experience sharper declines due to its higher liquidity and multi-layered use cases. For expert practitioners, this differential behavior underlines the importance of understanding the individual structural dynamics of each asset. For those managing their portfolios, the takeaway is clear. Whether you are a trader or a long-term investor, it is critical to focus on both technical flows and market sentiment. In practical terms, it is essential to monitor key indicators. For Bitcoin, focus on exchange outflows and sustained long-term holder behaviors. For Ethereum, keep an eye on staking trends, Layer 2 network activity, and fee burn rates. In both cases, integrating sentiment analysis with structural insights provides a more robust framework for navigating the market. The current landscape, with its widespread fear yet robust fundamentals, demonstrates that disciplined, probability-driven strategies usually outperform those based on reactionary impulses. As you analyze the market further, consider a mental checklist of key questions. Is Bitcoin's tradable supply contracting or expanding? Are Ethereum's staking numbers on an upward trend? Is Layer 2 network activity supporting a broader utility narrative? How are sentiment indicators trending? Are they skewed towards fear or greed? And finally, what is the nature of institutional flows? Consistently and rigorously answering these questions, backed by quantitative data, can empower you to make more informed decisions that stand the test of volatile market cycles. When I examine the current environment, I see that Bitcoin is tightening its supply, and Ethereum is not only tightening its supply but also expanding its utility, a combination that, historically, has led to asymmetric opportunities for those with disciplined strategies. The blend of structural accumulation and periodic emotional volatility is a scenario where deliberate, strategy-driven decisions can yield substantial long-term rewards. Even with heightened fear in the short term, the structural indicators remain fundamentally strong, making this a moment where technical acumen and risk discipline reward those who act with precision and calm. In conclusion, the technical and fundamental analyses of both Bitcoin and Ethereum underscore a period of dynamic evolution in the crypto markets. Bitcoin, with its shrinking tradable supply and steadfast long-term accumulation, is emerging as a macro asset that appeals to institutional investors and long-term holders. Meanwhile, Ethereum is transforming into a multifaceted digital asset that leverages yield generation, increasing scarcity through fee burns, and the exponential growth of Layer 2 networks to solidify its role as the foundation for decentralized applications. The narrative is data-driven and nuanced, emphasizing that while short-term volatility is inevitable, the underlying structures continue to evolve in favor of long-term value creation. For any trader or investor who navigates this landscape, the keys lie in understanding timeframes, monitoring on-chain flows, and combining nuanced sentiment with robust structural analysis. Ultimately, adopting a disciplined approach, one that marries advanced technical insights with measured risk management, ensures that you remain prepared to tackle both the surprising dips and the explosive recoveries that characterize the crypto market today. This environment, steeped in careful analysis and quantitative metrics, is where precision meets opportunity, allowing those with a deep understanding of market mechanics to not only weather the storms of volatility, but also capitalize on the inherent asymmetries offered by these flagship assets. Every statistical trend, every on-chain indicator, and every sentiment shift provides an opportunity to reassert your strategic position. Bitcoin's capacity to act as a digital store of value and Ethereum's emerging utility as digital infrastructure create a rich tapestry of market forces that reward the precise and counterintuitive strategies. As we take this journey through the metrics and mechanics of these major cryptocurrencies, it becomes increasingly clear that disciplined analysis and a deep understanding of structural fundamentals are the best tools an expert can wield. By continuing to examine these key metrics, exchange flows, staking statistics, Layer 2 performance and sentiment oscillations, you are not simply following the market, you are engaging with its very architecture. This script has taken you through a careful synthesis of advanced technical insights and historical data points that illustrate how and why Bitcoin and Ethereum remain at the forefront of innovation, volatility management, and economic utility. Keep this analysis in mind as you evaluate future moves, and remember that the market rewards those who understand the underlying code of the crypto economy. Every data point, every cycle, and every narrative twist tells a story of structural integrity and evolving utility, one that, if understood deeply, transforms market uncertainty into a realm of calculated opportunity. Embrace these insights and let them drive your strategy in navigating the ever-complex landscape of cryptocurrencies.